Good afternoon, gentlemen, and thanks very much for joining us on the Vox Markets Q&A. I'm glad to see it looks like you're 2 meters apart in strict social distancing. Your head of health and safety will be much relieved, I'm sure.
Yeah, we're certainly 2 meters apart.
Yeah, there we go.
Good. That's ticked the box. Bill, looking at both of your recent careers, you're fairly new to Galliford, but you've been in the construction industry man and boy. Perhaps you could give a bit of a potted history of your involvement in construction.
Yeah, sure, Alistair. So yes, I've been with Galliford Try 5 years now, so it's getting on a bit, but it's gone in a flash, I have to say. And prior to that, I was 25 years with Skanska. So I was man and boy with Skanska, and I started out on sites as a civil engineer and just came up through the ranks since then. So it's been a great career. I've enjoyed every moment of it.
And Andrew, you've been with the group since 2012. You became the finance director of Galliford Try in 2019, and you've been in various roles within the group.
That's right. Started here in 2012 as Group Financial Controller. I took various operational roles. After that, became Divisional Finance Director and then promoted to CFO in March 2019.
And the company itself, I'm sure most viewers will have seen the name Galliford Try. It's got a long record. Some of the companies that make up it have been around for 100 years or so. Bill, could you give a bit of a backdrop to the company itself?
Yeah, well, both Galliford and Try had their roots way back in the early 1900s. And that culminated in a merger in the year 2000 between Galliford and Try to form what was the old Galliford Try. And that had 3 constituent parts to it: the housing businesses, which are 2 of them, and then the construction business. We restructured the construction business in May last year, which was fortuitous. It was one thing I'd wanted to do since I started, and we progressed various actions to get to a stage. In May last year, we refocused the construction business and stopped doing the stuff that we didn't want to do and put more focus on the stuff that we're currently doing. And that was fortuitous in terms of its timing, insofar as the dust had settled on that restructure when the transaction with Bovis and our Duxbury came along. So it gave us a nice smooth transition into the current Galliford Try holdings.
Yeah. And Andrew, perhaps you can overlay some of the financial details of the demerger, which has left you with a lot of cash in your balance sheet.
Sure. Well, look, the demerger, I think, Alistair, recognised 2 things. Firstly, the operational benefit of having the 2 different businesses had really been superseded, and actually, there was opportunity for the businesses to thrive independent of each other more. And in fact, we're really seeing the benefit of that already from a construction perspective. And it also recognised the fact that our investors were increasingly wanting to invest into either house building or construction. And so again, there was a huge amount of unlocked value which we were able to release as part of the transaction. So what the transaction did is a £1.1 billion deal whereby we sold our house building businesses to Bovis, now Duxbury. And in return for that, our shareholders received shares in Bovis, as well as obviously retaining their shares in Galliford Try. And as part of the transaction, Bovis took on, we had a £100 million private placement debt facility that Bovis took over. They took over our pension scheme, so we've got no pension schemes left. And they also paid...
and it's fair to say, Andrew, that pension liabilities are always a bit of a concern for some investors in construction businesses.
Yeah, absolutely, and they can always create a cash outflow, which is unhelpful. So that was really helpful to get rid of the pension deficits and to move that across to Bovis. And then also we received, as part of the transaction, £300 million cash payment from Bovis, which we used to repay our debt facilities. And so since the 3rd of January 2020, we have been trading with cash on the balance sheet. And that strong balance sheet, that real recapitalisation of the business as part of the transaction has been really valuable. And already we're seeing, again, the benefits of that through our clients and with investors. So that's been a really strong feature of the deal.
So a much more cleaned up, simple business for investors to get their heads around.
It's a much more simple business with a clean, straightforward, simple balance sheet as well, and a really strong balance sheet to that.
Mm-hmm. And it would be fair to say that prior to that, the construction part of the old Galliford Try did have some challenging contracts, particularly in Scotland. Perhaps, Bill, you could go into the backdrop of that and then start describing how the group has changed since then.
Yeah, certainly. The interesting thing, Alistair, when I was with Skanska, actually, I declined to bid for both of the projects in Scotland that you referred to.
That's quite telling, Bill.
And for my sins, I inherited both of them. But apart from that, what got us into those problems was the wrong attitude to risk. And the single biggest thing we've changed since those is our attitude and our management of risk. So we've got really robust procedures, a sort of set of parameters, if you will, that govern what work we'll do, and more importantly, as I always say, what we won't do. So we look for things like the client, the terms and conditions, the cash flow profile, where it is geographically, do we have the people, do we have the supply chain, do we have the expertise, all these different parameters. And only if those all come up green will we bid for the project. And bearing in mind that 91% of our work is through frameworks. That means that we pretty much have a strong repeat client base. So a lot of the time, those projects are in the green zone, as we call it. Occasionally, something comes up either by a red flag or by dint of its size to the exec board. We'll then have a look at it and decide whether we bid it or not. But the single biggest change is this focus on really robust risk management. And that's sorry.
So, Bill, could you explain, first of all, to those investors that might not have heard of framework contracts, what is a framework contract, what sort of clients enter into framework contracts, and, if something goes wrong, how do you overcome it? Yeah.
Well, frameworks are basically you're on a short list of contractors to do all of the work for that particular client. So, for example, we have, we're on every major framework that we want to be on, actually, mainly for government clients, so Educational Schools Funding Agency, DIO, Defence Infrastructure Organisation, NHS, etc., Department of Justice. And what that means is we normally have some sort of a mini competition between 2, 3, sometimes 4 of the companies on the framework, typically on a quality price basis. So in other words, you're not bidding on price alone, you're bidding on quality. And by quality, I mean the quality of our balance sheet, the quality of our track record, of our people, of our supply chain, of our particular proposals, perhaps for the project. And the commercial considerations are sort of secondary. The client then typically chooses one of those contractors, ourselves in this example, and then we negotiate the project's actual tender price. So it's a 2-stage process, which means our ability to mitigate the risk is enhanced.
So that's very different to the way I remember, and no doubt you remember contractors going back 20, 30 years. In terms of, who wins work on a framework, have you got a sort of rough idea of how often you win a project without being the lowest bid?
Quite regularly, actually, and of course, winning a project from not the lowest is always the best place to be.
Yeah.
So there is some good evidence, and some evidence where clients have come to us and negotiated very sizable projects on the strength of our balance sheet, on the strength of their confidence in our ability to A, perform the work, and of course B, still being around to complete the work. So our balance sheet is a real differentiator here.
Yeah. And you said earlier on, Bill, that it's important what jobs you bid for, but as importantly, what you don't bid for. Possibly looking back to the 2 loss-making contracts, what would be the imaginary project and contractual terms you wouldn't bid for these days?
Well, if you take some of those jobs in Scotland, they're in a remote location. They've got a supply chain that's just not big enough for the project itself. So it's difficult to get people there. The weather is inclement all the time.
Yeah.
These are the sorts of things that make it difficult. And then when you add those dynamics into bidding in those examples where the lowest price was going to win, that's not a good combination. So all of our work in infrastructure now is done on a contractual basis, which is target cost reimbursable. So in other words, we're on a framework, we were allocated a particular project, a road, for example. We then design that road transparently with the client. We build up its target price, the risk profile, the program, all of those things. We agree the target price, and then we go off and we construct the project. We pay our actual cost plus our fee against target cost. So it's a really good form of contract which enjoins all the parties, which means if something does go slightly awry, all parties are incentivized to work together to mitigate that issue, whatever it will be.
So things do go wrong from time to time, but you've got a framework, as it were, to problem solve on the job.
That's right, yeah. I mean, things do go wrong in construction. I'd never say otherwise, but the key thing about our risk management is that no one project can impact us. On a portfolio basis, if one project goes slightly awry, it will be immaterial in the portfolio. And that's the whole basis of the type of work that we go for and the constituents of our order book, which is really what gives us the confidence going forward, to say what we've said about reinstating guidance and resuming dividend payments on the back of our confidence in the quality of the order book.
Sure. And Andrew, the sector backdrop over the last few years with the demise of Carillion in particular is, a bit, makes investors a little bit nervous. Can you say that from a finance director's point of view, how you differ from those sort of companies and their sort of approach? First of all, you have cash. That's the absolutely key thing. But could you give
we have cash, which is really important to our clients as well as to our investors, and also means that, again, we can sign contracts not just because of a cash profile, but because that's part of an overall series of metrics. But I think, Bill's talked a lot about the way that clients procure, which I think has matured in the last few years. And I think our accounting policies have matured as well. So we tightened up, for example, over the last few years, the way that we recognise revenue. So particularly things like contract variations. So we only recognise those when they're either agreed or they're highly probable of being agreed. We don't recognise claims until they're virtually certain. So what that means is that we're very cautious about the way that we recognise our revenue.
Yeah.
In terms of profit, we're also cautious, so we don't recognise any profit in the early stage of a contract. We make sure that we understand how the contract is playing out on the ground. So, and you ally those, in my mind, those accounting practices with the risk profile that Bill's talked about, and make sure we've got the right risk profile in the portfolio. And I think you put those two things together, and that's what gives us a balance sheet which is appropriately stated, is conservatively stated, and that also, gives us good confidence in terms of the position that we're in. I should say as well, actually, also on the balance sheet, we've got some private finance initiative assets and PFI assets,
indeed,
and they're also conservatively valued. So that conservatism kind of is seen throughout our balance sheet. And I think, for me, that strong financial position, the strong balance sheet, the prudent accounting, it's important for our investors, and it's increasingly important for our clients as well. They want robust and sound partners to do business with.
Could you quickly elaborate on the private finance assets? The PFI, many people know it as, or PPP, but they have their concessions with a monetary value. Could you quickly explain that?
Correct. So these are investments that we hold. They relate to assets that we've built, typically roads, schools, hospitals, most of them in Scotland, not entirely. And these are assets, they're operating assets, and they're deriving as an interest income. So that income comes in, not in our operating profit, but through the interest income line.
And you can buy or sell equity stakes in those investments as quite an active secondary market.
It's quite an active secondary market, and particularly for good quality assets, which are the nature of the assets that we hold. So for now, there's we've got no need to sell those assets, and so because they're generating us a good return, then that's why we're holding those assets on the books.
And what's the director's valuation of those just now?
So those are in the books at the end of June 2020 at £41.7 million. Yep. And probably the range, depending on the discount rate that you use, is probably between the 41 and 47 million, that sort of order of magnitude.
Sure. Bill, it's we're living through extraordinary times, but one of the sectors that seems to have done best coming out of lockdown has been construction and housing, with the government making very big commitments to both infrastructure in its various forms and to house building. Can you outline where you see the future for construction demand?
Well, as you say, it's certainly robust, Alistair. We've got more than 95% of this year's work in hand, and something like 75-80% of next year's work in hand. So the first thing is that we are already well set, and that plays well back to the risk management perspective, that we don't need to go chasing work. We focused on good quality work. So the market looks good to us. The government signals are pretty robust in terms of build back better and the levelling up agenda and so on. And all the signs we've seen so far is that is coming to fruition. That the government will use the construction industry to help build a way out of the issues of COVID. We have performed well through the whole COVID environment, and our people have been fantastic throughout. They've really been fantastic. So we've come through in good shape. We've got a good order book, and the market looks robust in the medium term. So I think we're in a good place altogether. Yeah.
And looking at some of the main sectors you serve, can you do a quick run through the top 3 or 4?
Sure. Education is our biggest sector, and we're a top 3 supplier to the Education Schools Funding Agency. Yep. And they've got, the demographics of that sector are interesting insofar as obviously the kids get older and the schooling needs change and they move around the country and so on. So the demographics of that sector are really strong. And the SFA would like to accelerate its school building program as part of their overall sort of economic stimulus. Overall, government, just as an aside, the construction playbook has just been published.
Yeah, I saw that.
Yeah, and that's going to put more focus, or is putting more focus on what I'd call the whole quality agenda over price. Yeah. So that's all about sustainability and carbon and modern methods of manufacture and so on over lowest price. Of course, balance sheet comes back into that equation. So I was pleased to see that. We had some input into it, and I'm pleased to see it. I think it'll advance the industry. So schools, certainly a big sector for us. Defence is also a big sector. The regiments are coming home. The DIO is consolidating regiments into fewer, bigger garrisons. So there's work to do there. And we construct accommodation schemes and operational facilities for all the arms of the defence services. The NHS, obviously looking inwards at the moment, looking after people, that's quite right. I think in the fullness of time, whenever that is, I think they'll start to talk about, what does all this mean for their built environment and what changes need to be made. So I think NHS will be fairly quiet for a bit, but once the dust has settled, we'll come back quite strongly. And then in infrastructure, of course, roads is the government is committed to a huge road spend, some £27 billion in the next strategic period, which is really good. We've got a good position with Highways England and with many local authorities around the country. And in water, which is obviously regulated, again, that's a steady industry through its regulated status. So overall, the pipeline does look robust for us.
Sure. And you mentioned NHS. I was going to touch on the broader issues of health and obviously COVID. First of all, from your client's point of view, has that changed the way they are thinking of building, of designing or building their facilities in the future? And how will COVID change your working practices? Because, I don't think it's going to go away in a hurry. And we're hearing that, new variants of the virus may be appearing?
Yeah, I've not seen any evidence that people are changing the design of buildings on the back of COVID. I think the way they're using buildings on the back of COVID is very different.
Yeah.
But I think that the sort of balance between working from home and working in the office or wherever gives them the space to do that. So currently, I see no difference. Actually, what we see are clients looking through COVID and saying, well, in a year or 2 or 3 years' time, this is going to be behind us. We'll have a vaccine, we'll have better treatments, et cetera, and it'll be, sort of treated a bit more like the flu is today, I suppose. And that's what I see more of, Alistair, is clients looking through this and saying, let's get on and build this, because in 2 years' time or 3 years' time, when you finished it, we'll be through this and we'll be away again. I see more of that in the form, actually.
Sure. And looking at, Andrew, looking at what Bill's been describing, it's pretty upbeat, your view of the future, and indeed as a company you've come out with some pretty bullish projections for the next 2 or 3 years. Perhaps you could talk us through some of those.
Yeah, absolutely. Well, I think the projections we've set out, hopefully they're very clear for investors to see what we're striving for. They're ambitious, but we've outlined through the order book and through our process how we'll get there. So we've said that our revenue over the medium term will be in the range of 1.2 to 1.5 billion pounds. Our focus is absolutely on the bottom line. It's about the quality of earnings. It's about margin enhancement. But what that revenue does, that gives us the critical mass to run the business. It means that we get the right number of contracts, but we don't need to go chasing your contracts and the wrong sorts of contracts. So that focus on discipline, on risk management, which Bill's referred to, is contract selectivity. It plays right into that revenue range. And then the focus on margin comes from the contracts we've selected, our focus on operational efficiency, on our cost base. And so we've said that, again, in the medium term, we'll get our operating margin, after all central costs, after all the costs, will be over 2%. So we'll continue to drive that margin up over the next few years.
And that comes from what margin previously?
Well, so we said that the current year, our margin will be about 1.5% pre-central costs. So our central costs are still a little bit high at the moment post the transaction. There's some things like some of the properties, the building we're sat in at the moment, where the costs are a little bit high, and it'll take us some time to get those down. So that's a good margin increment from where we are today. And of course, what that will do, Alistair, is drive our EPS, and that in turn will drive our dividend performance. And we've said that we'll reinstate our dividend with our half-year results in this current financial year, so in the spring of 21.
And you've given an indication on the dividend cover, so people can do the sums.
Yeah, so we've set out at the time of the transaction a dividend cover of 3 times, which and of course our cash position allows us to make sure that dividend is absolutely affordable.
So the combination of rising revenue, improving margin, lower central costs, and good cash flow, it all looks encouraging. But where could it possibly go wrong?
Well, the issue with the industry is that there are too many good examples of that, and that is exactly why we're doing what we're doing. So when you look at all the work we've done on risk management, on getting the best people into the company, on robust underlying systems, on all of the attributes or are supported by a fantastic order book, that's how you get stability and predictability. And that's what we aim to do. We to all intents and purposes, a new company from the 3rd of January, and we want to establish our reputation as being reliable, predictable. We do what we say we're going to do, and that's founded on a solid foundation. So this year, notwithstanding all the other challenges out with normal business, we've been busy just making sure that foundation is solid, and that's what we'll continue to do. And obviously, it will accelerate as we move through the process.
So risk minimization really is critical for everything you do.
Yes, but in concert with the best people and the best processes and a good client base and a good order book and all of those things, absolutely.
So all pretty encouraging. I mean, what I think I've referred to what keeps you awake at night, worrying. You've just answered that. What keeps you awake at night, both of you, in terms of operational opportunities?
Well, I think, well, firstly, nothing keeps me awake at night. but when I do think about it, I'm really optimistic for the future. As we've articulated, we're in a good place from a balance sheet position, from an order book position, from a cultural position, from a process position. And obviously, we seek to improve on all of that. We're not saying we're perfect, because we're not, but we'll continue working away at that. But we're in a really good space. So my thoughts always turn to, what do we look like in 2 years, 3 years, 4 years' time? And that's what enthuses me. And we're going to go there from a really solid spot. That's good.
Yeah, for me, Alistair, I mean, what excites me is the opportunity here to build a genuinely progressive company, real focus on people and sustainability. Yeah, and as we've said, to deliver what we said we're going to deliver, I think there's a real opportunity for us to do all of those things. And for me, that's a great opportunity.
Great. Well, thank you very much. Hopefully, before too long, we can all meet up and with investors in the flesh. But thank you, both of you, and thank you for the investors for listening.
Thanks, Alistair.
Thanks, Alistair. Take care.
Thank you.